Welcome back to Trades and Gains. Happy New Year's Eve, everybody. And, well, this is the one trading day where liquidity disappears. Common sense takes PTO, and CNBC pretends, quote unquote, nothing weird is happening. Today is basically half the desk's empty, the interns running the algos, and one hedge fund guy still trading because, well, he hates his family and never went home for the holidays. So if price action feels fake, congratulations, you're emotionally intelligent. Let's break down what actually matters today before everyone logs off and pretends 2026 is a fresh start. Quick housekeeping because this alone moves price today. Stocks, the New York Stock Exchange and NASDAQ, they're open today, regular hours, and they're closed tomorrow for New Year's Day. Bonds, they close early at 2 p.m. EST. Translation, rates volatility dries up around midday, probably within the next hour and a half or so, because this video is being recorded at 12:51 p.m. Eastern. Crypto, we're seeing open 24/7 because, well, crypto doesn't believe in holidays or risk management for that matter. They'll take your money 7 days a week, 24 hours a day. Now, why does this matter exactly? Well, low participation equals outsized moves, thin volume equals fake breakouts, and one options desk can move SPY more than all of retail combined. This is positioning week, not conviction week. Now, let's talk about the real headline here. Nvidia is scrambling to ramp H200 production for China. This is huge, not because of the headline, but because what it exposes. Here's the setup. Chinese firms ordered 2+ million H200 chips. Nvidia only has 700,000 units in stock. Nvidia calls TSMC like, hey, what's good? And suddenly, production ramps up in Q2 of 2026. Pricing is $27,000 per chip. Demand is 6 times more powerful than the H20. And China is like, yeah, we'll allow it. Maybe don't rush us. This tells you 3 things. 3. AI demand, it is not slowing. Anyone calling the AI trade, quote unquote, over is just bad at reading supply chains at the end of the day. Number 2, China is still critical to Nvidia's growth. Even with tariffs and fees, margins still work. And by the way, that makes sense because China is responsible for buying like 53% of the chip supply in the world. So what are we thinking here? I'm not sure on the number. I think they either make up 19% or 23% of like AMD's total annual reoccurring revenue, just to give you perspective, and nobody likes AMD. And the third point, TSMC stays king. If TSMC sneezes, well, the NASDAQ is going to go ahead and catch pneumonia here. This isn't Nvidia being desperate. This is Nvidia defending dominance, as we talked about when they made their last acquisition. It wasn't a play of desperation. It was a play of keeping your friends close and your enemies even closer, and in this case, acquiring them. Now, let's go ahead, kick it into second gear because this matter weighs more than Twitter thinks. 30-year mortgage rates are at 6.15%, the lowest level of 2025. It's not sexy, it's not viral, but it's massively important. And by the way, shout out to myself. I wrote a thesis about how breaking 6% would be like a Herculean task, and rates would most likely stay at about 6%, because that would be looked at as the new COVID level, with them hovering between 6.2 to 6.5%, and 6.1 would be like the breaking point where we could maybe see some change. But realistically, I think we still see that 6% as the new norm. Here's why this is important. Rates were near 7% most of the year. Housing basically froze, mobility, it died, and the labor flexibility just vanished. Now, contracts up 3%, buyers cautiously are starting to return, and sellers are less terrified. This, by the way, does not mean housing is back. It means Housing just stopped bleeding out. They finally stitched up the wound, and the guy's guts are not about to fall out of his stomach. All right. And for the Fed, this is exactly what they want: cooling inflation without detonation of housing, because that is like what I thought they would have to blow the housing market up in order to, like, it's like unplugging your computer and plugging it back in. It needed a hard reset, and that's what it was looking like. And they didn't need to do this without mass layoffs. This is how soft landings actually look. They're boring, they're uneven, and most importantly, they're frustrating. Now, let's talk about everybody's favorite alternative to gold, and that is Bitcoin. Bitcoin, boys. It's hungover, but don't worry, it's not dead. Bitcoin, it's finishing the year down 5% after being up massively earlier is in its peak crypto energy. Now, what's happening exactly? Well, there's forced liquidations, ETF rebalancing, long-term holders are trimming, and zero new narrative dopamine for people to hopium their way into a bag, as they would say. But here's the part everyone's gonna miss, right? There were 3 straight down months, which is rare for Bitcoin because we usually see it recover within a couple weeks or the next month or whatever the case might be. And historically, rebounds often follow. The most credible outlooks, 80K to 100K range in Q1, accumulation, not moonshots, and volatility compression before expansion. Crypto isn't broken right now. It's just acting like a market again, which for crypto is, let's call this its character development arc, right? Now, the most misunderstood data point today, jobless claims dropped to 199,000. This is the lowest in a month. Bullish, recessionary, confusing. Yes, it's all 3 of those things. But here's the reality. Layoffs are low. Hiring is also low. Unemployment is rising anyway. And that's not a recession. That's a frozen labor market. Now, why is this happening? Well, we're seeing an immigration crackdown thanks to Trump, which means we have a tighter labor supply. AI productivity, which is causing fewer new hires because those entry-level jobs that college kids used to fight for are now being done by ChatGPT and other models. Tariffs are creating cautious capex, meaning people are unsure what's going to happen with tariffs, so they're less willing to spend their money. Businesses, right? Policy uncertainty. That's another thing. Everyone's just sitting on their hands waiting to see what is going to happen. Now, the Fed, it's going to hate this setup because inflation is still sticky, employment is weakening slowly, and there's no obvious policy lever left. This is why rate cuts are political landmines at this point. So what does this mean for traders? Let's land the plane. Market reality check. Well, liquidity is thin, positioning over fundamentals, and volatility is suppressed for now. The trading takeaways: respect fake moves, watch options positioning, not headlines. In January, that's going to be our repricing, not continuation. AI is not dead, but leadership may rotate, and housing stabilizing helps the floor. Labor data, well, it stays the wild card. So the big picture here, this market, it's not euphoric, it's carefully optimistic and extremely fragile. And that's when professionals make money, not by predicting headlines, but by understanding where pressure is building. So enjoy New Year's Eve, hydrate, don't overtrade, and most importantly, remember, if the market feels quiet today, it's because everyone's getting ready to fight again in January. This is Trades and Gains, powered by Investor Central Club. We'll see you in 2026 when the real games begin. Have a great day, everybody.